Hello, everyone. My name is Teresa Rickard. I lead our practice growth and marketing team here at Jones & Roth. Want to extend a warm welcome to everyone who has joined us. We're really glad you're here for today's session. Today, we're going to be diving in to talk about the basics of financial statements. It's an awesome opportunity to bring your questions and get expert answers and advice. So please type your questions into the question panel so we can get those answered for you today. Also, you can access a copy of the slides themselves in the handout panel section. Tomorrow, we'll send out a link to the recording and the slides, so you'll have that to watch on demand or share it with someone that you know. And before we get started, I want to just do a quick intro to our firm, Jones & Roth. We're one of the largest CPA and advisory firms that's headquartered in Oregon. We have offices in Eugene, Bend, and Hillsboro. And our small business team is a team of experts who work in small business accounting best practices. So we work with small to mid-sized businesses. We provide business coaching, expert tax and accounting guidance, and employer support. Our mission is to help you as an owner reach your professional and your personal financial goals. With us today is Trisha Duncan. I'm thrilled to be able to introduce her. She leads our small business group and firm operations, and her areas of expertise really span a wide variety of areas, including assurance, tax, advisory, and a variety of industry and service niche areas. She is a University of Oregon alumni and enjoys running marathons, CrossFit, hiking, travel, family, volunteering. She's a super awesome gal. Trisha, welcome. Thanks for being here with us today.
Yeah. Thank you, Teresa. And welcome to everybody. We're excited to have you and chat with you about financial statements today. Like Teresa said, feel free to throw questions in the chats. We don't have hundreds of you online, so it's easier to just throw it in the chat as you have a question. We can try to address it as we go. We'll also save some time at the end and be available all the way till 1 if you want to talk one-on-one afterwards. So for today, we're going to talk about why do we have financial statements? Why do you have them? What are they for? We're going to talk a little bit about the types of financial statements that are out there to make sure you understand those. And then we'll go through each of the 3 main financial statements to go through what they mean, what you should think about, and how you can use them in running your business. So purpose of financial statements, maybe in the chat, get you guys involved. Why do we have financial statements? Why are they important? Do you have financial statements that you use? Why do you need financial statements? So throw things in the chat and I'll read them out as we go. Guys are being quiet. All right, we'll jump in. First thing, a lot of people finance portions of their business or take a loan out to buy equipment or property, and often the banks will require that you provide them financial statements that show them that you are able to pay back their loan, and they will ask for those over different points of time to ensure you can continue to pay back their loan. So bank requirements, lending requirements are definitely one reason that organizations have financial statements. Some organizations have regulatory requirements. Many nonprofits or other organizations receive funding from the federal government. And if they have enough funding, they require an audited financial statement. So there could be other regulatory requirements in your industry. Construction contractors often have bonding requirements, and bonding agencies require financial statements to again show that you're going to be able to pay back loans or fill your commitments to the jobs you have out there. So those are some external requirements of financial statements. Other reasons people have financial statements is sometimes organizations just want CPAs to come in and have a look at their financial statements to ensure that there's kind of an independent check on your accounting system and your financials. Nonprofits will often do this because they want the public to trust that they are upstanding organization that's using the funds appropriately and providing services with donations. So sometimes it's just an independent check to make sure things are running well. But probably the biggest use of financial statements or financial reports is as a management tool. So if you have timely, accurate, relevant financial information, that information can help you make decisions about your business, identify trends, identify problems, and adapt to those in a quick manner. So a lot of small business could use their financial statements a little bit more in helping run their business, but the key is getting accurate, timely, relevant information for you. So we'll talk through that as we go through. All right, so levels of financial statements. Some of this is a little public service as a CPA to make sure that the public understands the different levels of financial statements and what the CPA does in helping prepare those. So internal financial statements are things that you prepare within your organization and your team prepares. And those can look however you need them to look to run your business effectively. The other 4 listed on there are CPA engagements, where CPAs are involved in providing some oversight to your financial statements, and each one of those has very different levels of CPA assurance about the financial statements. So I'm not going to read this slide in details. You do have this handout, but I'm just going to touch on a few things. We often find the public has a perception that if a CPA is involved in any portion of a financial statement, that we are making sure there's no errors, no fraud, nothing wrong, everything's on the up and up. And while there's different levels of assurance to some of those things, it is not reasonable or cost effective for anyone to assure all of those things. So the levels go from the lowest level to the most complex, from left to right. So some CPAs help organizations with financial statement preparation. So essentially taking your chart of accounts or your GL and helping you put it into a format that is submitted either internally or to a third party. The CPA's name is not on anything. They're not looking at any background data or looking at any support. They're just purely helping you take your own numbers and putting them into a format that is useful for yourself or others. The CPA's name is not on any of those statements, so the third party doesn't even know if someone looked at it. What most people hear more about are the compiled, reviewed, or audited financial statements. A compilation is a step up from a preparation in that we help put together a financial statement in a reporting format and make sure that nothing looks odd in that format. But we are not investigating things, looking at source documents, asking questions. It's just a pure look at that and making sure that it looks appropriate. Generally, lower financing amounts, smaller loans, maybe banks will look at that and they value just some other eyes on the financial statements before they come to them. A review starts bringing in a lot more assurance. So there's limited assurance that there's no material modifications should be made. So it's generally good. There could be some minor errors or issues, but there's nothing big that would significantly change your opinion on that organization based on the financials. So primarily that work is done through analytical procedures and inquiry. So looking at your industry, the economy, what we know, does the financial statements make sense this year and in terms of maybe prior years or trend analysis? And if something looks odd, we're asking some questions and digging a little bit deeper to make sure it still makes sense. So we do issue a formal report that says limited assurance. And if there's problems, then the report says that. Generally, as the complexity of the financing or the amount of financing increases, so does the level of financial statements. So we see a lot of reviews. An audit is what most people think about if CPAs are involved with financial statements. And that is providing reasonable assurance that the financial statements are materially correct. So they're free of big errors. And so we express an opinion on whether they're presented fairly in accordance with whatever financial framework. And we do modify the report if there's problems or findings. It's with the audit that we're digging in a little deeper. We're actually performing verification and substantiation procedures. We're looking at the documentation. We might talk to third parties. We ask a lot of questions internally, and we have to understand your internal control processes and your fraud risk and create audit procedures that work around those. So generally, these are a lot more public oversight, grant or federal funding, or really high complex levels of financing where the users of the financial statements want some assurance that things are correct. So that's my little public service about what does a CPA do when they're engaged in financial statements, and having an awareness of what's going on in your organization and what is it that the CPA is doing and providing assurance around is important. All right, and again, ask questions if you have any in the chat. Along with the levels of financial statements, we have different basis of accounting. So I'm going to ask for a chat again, so hopefully I see something in there. Love to know what basis of accounting your financial statements are prepared on currently, or if you know. So as I'm going through that, hopefully I'll see some chats pop in. The simplest basis of accounting is cash basis. So when you make a sale and you receive cash from the customer, you record the revenue and the cash to the bank. So it's purely when the cash hits your bank or leaves your bank. Pretty simple. Financial statements with cash basis. Accrual or GAAP, generally accepted accounting principles, looks at how transactions happen when they're incurred or earned. So if I sold you something and you aren't going to pay me until next month, that would be an accounts receivable. I'm going to show that as revenue when you bought it and show that I have money owing from you on my financial statements. So an accrual is when the revenue is earned and when the expense is incurred. And then some organizations will have a modified accrual, so a combo of the cash and accrual. Others will have financial statements based on tax, so tax components, tax depreciation, tax rules around when you recognize income and expenses. And sometimes there's other industry-specific issues or things like that. So the presentation, the data in your financial statements can look very different and based on these bases of accounting. So don't hesitate to ask if you have any questions on those, and happy to talk about them more. But it's important to know which one it is, especially if you're comparing that to other people's financial statements or industry financial statements. All right. A little bit of background that took us to here. So let's talk about what are financial statements, and we're going to start with the passage of time because that's important to understand. So different financial statements tell us different things. So the balance sheet is a point in time. It's what a financial component of the business at a point in time. So this graphic shows you we can have that point of time being the beginning of the year, January 1st, 2022, and the end of the year. So it's a snapshot of that day, what you own and what you owe as of that day. The income statement and the statement of cash flows are a summary of activity for a period of time. And so if we were looking at this example, it would be a year for January 1st, 2022 to December 31st, 2022. So income statements, statements of cash flows can be a month, a quarter, a year, 3 years, a week. You need to know what that component is as you're comparing it to yourself and others. So those are important to remember. Balance sheet, point in time. The other statements are a period of time. All right, let's start with the balance sheet. So why is it called the balance sheet? Accountants love the balance sheet because there's an equation and it balances. So on a balance sheet, assets always equal liabilities plus equity. So assets are things we own, liabilities are things we owe, and equity is the cumulative earnings and contributions over time minus anything you've taken out of the business. So accountants love that because if they do their work right, it balances and you feel really good about things. So that's why it's called a balance sheet. On the balance sheet, we also look at within assets and within liabilities, what is current, what is something that we can access within the next year, and what is long-term, something we have to access longer term. So equipment, property, land. On the liability side, same thing. What do we need to pay within the next year? And what is something that we are going to pay longer term? So if you have a loan, you have portions that are due in the next 12 months, and then you have portions that are due longer term. So we look at those as we look at a balance sheet because there's some ratios we can look at to see, is the business healthy? Does this look like we can deal with things if something goes wrong, right? So assets, again, are what you own. And you can see on this accrual basis financial statement that there's current assets and then there's the longer term assets separated out. So generally things in current assets are going to be cash, right? Your bank account, that's liquid, that you can get to that immediately. You might have CDs or other short-term investments, but within the course of a year, it's going to turn over into cash. And then things like accounts receivable, those are customers bought something, they need to pay you. Generally, you expect them to pay you in a short period of time. So that would be a current asset. Your inventory, most organizations aren't expecting to hold inventory for years. You want that to turn over within the 12 months. And things like prepaid expenses or accrued expenses could be things like business insurance. I paid for 12 months of my business insurance, and I'm going to accrue the portion that is for the future. And then your longer term assets are things you own, like furniture, equipment, property, land. Those are assets that are going to benefit the organization over the long term. And same on the liability side. So things that you have to pay in the next 12 months will be in current liabilities. So maybe a line of credit, the portion of your loan that's due in the next 12 months, things you've bought from your vendors that you need to pay, those sorts of things. Again, you'll see that this is as of December 31st, and I picked an old date, 2001, a long time ago. So this is a point in time. So on that date, these are the things we owned, these are the things we owe. And then equity, again, is the cumulative earnings or losses in your organization, plus what you've given to the company. So as you started the company, you might have bought stock or shares or invested dollars or equipment. So what did you give to the company to get going, minus what you've taken out. So if as an owner, you're taking distributions out of your organization, that would reduce your equity. But as all the accountants love, you can see total assets equal total liabilities and equity. If those don't match up, you got a problem somewhere and we have to figure out what it looks like. So basics on balance sheet. Some of the other things on balance sheets we'll talk about later are the ratios that banks use or you can use to look at the health of your business, such as the current ratio, which is current assets to current liabilities. You can look at your debt to your equity. You can compare those things to yourself over time, industry, general other companies, those sorts of things. So there's key things on here that help trigger maybe questions that you need to consider about the future success or health of your organization. All right, let's move on to the income statement. So why is it called an income statement? And different organizations may call this different things. So some people call it a profit and loss statement, and nonprofit, there's another statement name. Government has a different name. So people use it for different reasons, or have names for different reasons. But essentially, it's your revenue minus your expenses equals your net income, which is why we call it an income or profit and loss statement. So simple one, this is a very simple one. Again, it's a period of time. So this one's for the year ended December 31st, 2001. So 12 months of information. And very simple: sales, cost of goods sold, gross profit, other types of expenses that are operating related. So you have your operating income and then your non-operating expenses, right? So operating income is all the things that you do in the normal course of your business, the revenue that came in, the cost to get to that revenue point. And then anything past operating income on an income statement is things that aren't related to the daily operations. So interest expense is usually due to financing. You had to finance some equipment and you're paying interest expense on top of that. It doesn't mean it's part of your daily operations, so we want to separate it out, right? So taxes could be down there depending on your entity. There could be other things down there. Couple things to think about here. So here's your annual data with your dollars, right? So you have $60,000 of sales. To the right of that, you see percentages. So we call these common size financial statements, where on the income statement, we look at all your numbers as a percent of revenue. So sales is going to be 100%. And then we go through cost of goods sold, gross profit, all those other components, and show them as a percent of sales, because sometimes these percentages will give you better triggers to problems than the pure dollar numbers. So we're going to look at some of those later, but this can be very helpful. Other things to think about on the income statement is what period of times do you want to see? So some organizations will show the month and a year to date, or a month and the budget, or all of three of those things. Some organizations will show each month and a total year to date. Some will have common size with all of those. It's figuring out what you need to run your business well. So there's presentation you need externally, but internally, how much detail is useful for you, and how do we present it in a way that you can drill into what the key issues are? So some organizations might have an income statement by department, by location, by product type. They may split out sales into major categories, same with cost of goods sold. They might want these other operating expenses to have different categories that are relevant to your business. The key is be thoughtful about what you look at so that you can drill into what's important and not get caught up in too much minutia, but not merge down so much that you miss something. So you have to kind of play with this to figure out what's most useful for your organization. And again, we've got clients doing all sorts of different things based on their organization, what's important to them. So lots of things to think about in here. Don't overwhelm yourself with data, but make sure you've got enough of the detail to be able to do something with it. All right, cash flow statement. So it's called a cash flow statement because it talks about what happens to your cash. Where are you using the cash? And I'm going to go through the definitions of the very formal cash flow statement, and then I'm going to show you maybe a more useful management cash flow approach. But making sure you understand, if you do have financial statements prepared by a CPA or prepared with a CPA, you understand what these categories mean, and then we'll look at maybe a different way to approach it that's a little more helpful in the day-to-day. So in a cash flow statement, it's essentially telling you your start of your cash, your end of your cash, and what happened to the cash throughout the year. It's broken into three main categories: operating cash flow, all the stuff in your normal course of business. Investing cash flow is around what have you invested in that's going to help the future of your business. So that could be equipment, that could be financial investments, securities, mutual funds, things like that. And then financing is how you finance your business, right? So debt, either receipt of debt, so you have new debt proceeds to purchase more equipment. You gave contributions as an owner to the organization, so your capital went up. Payments on your debt are negative cash flows, and if you take money out of your organization as an owner, it's a withdrawal or a distribution. That's all within financing. And then the trickiest part about cash flow statements is there are transactions that hit your income statement that aren't cash, like depreciation, or you sold equipment or property and you had a gain on the sale. Those aren't necessarily cash in your bank account, but we're going to adjust your income number to reflect that on the cash flow statement. So cash flow is complicated for accountants and not so simple if you didn't take your accounting class. And so understanding the general picture, and then again, we'll look at a maybe easier way to look at that. So essentially the cash flow statement is going to say, this is the cash that was provided or used by your operations. And hopefully that's a provided, because if your operations are not creating net positive cash flow, you're going to have some problems. And then we add or subtract the cash provided or used for investing activities, add or subtract the cash provided or used for financing activities to get the net change in cash. And we reconcile that to the beginning and ending cash flow of the year. So if you're cash basis, it's much simpler. If you're accrual basis, there's more components in it. So just briefly, without getting in too much detail, this starts with your net income. So from an operating standpoint, here's my net income. And then it reconciles some non-cash things. So depreciation is equipment we purchased, but instead of taking it as a deduction or expense in that year, we have to spread that over the life of the asset. So after year one, it's not a cash component, it's a journal entry we're making. So we have to fix that. So we add that back. And then we go through the balance sheet and say, how do the balance sheet items impact cash, essentially? So did accounts receivable go up or down? And how would that impact our cash account to reconcile to our net cash by operating activities? Then this company purchased some equipment. That one's easy. Financing, they increased their line of credit, so they had more cash. They had some proceeds from new debt. They paid on debt, and the owner took out some money. And when you add all three categories up, there was a net increase in cash for the year. We add that to the beginning of the year balance, and this should match your balance sheet for the end of the year. So this gets complicated and it's hard to read and not super useful from a month-to-month standpoint. What I like, and we use with a lot of our small business clients, is a graphical version of that. It's a little easier to understand and visually see. So same sort of thing. We started with our net income. So our beginning cash in this example was about $30,000. There was net income that brought it up to a little under 60. We dealt with depreciation because that was taken out of our net income, so we're going to add it back. And then we start going through the balance sheet, and this is where it's useful. So if I collect more receivables, so my accounts receivable number went down, I have more cash, because essentially accounts receivable, you're lending to your customers while you gave them the product, the service. They are going to pay you later, so you're lending to them. So when accounts receivable goes down, you have higher cash flow. So it gets you thinking about, oh, what happened there, right? And then you go through and you say, okay, inventory increased. Well, I had to pay out for that inventory, so I was using cash to do that. So an increase in inventory brings my cash down. And then you work through the balance sheet that way, and you can kind of visually see what happened. So this one, accounts payable went down. So we paid out more cash. We had some new loans, so we had cash coming in. And then this big long line, the owner took out some funds. So it brought cash way down past where we started. A lot of that was this owner distributions, right? So sometimes the visual component makes the cash flow thinking a little easier to understand. questions so far? I haven't seen any pop up. All right. Okay, let's talk about using the financial statements as a management tool. So we talked a little bit about setting up the balance sheet and the income statement for you. Like, how is that useful for you, your managers, your departments, whatever components of users internally you might have. That's very important. Some other things to consider are looking at historical trend analysis, industry analysis. Some industries have very good data about their organizations within their industry. So like the dental industry has very targeted information that you can find that says, here's a typical gross profit, here's a typical amount spent on hygienists as a percentage of sales, and can give you kind of a place, how do I compare to my peers along the way. Trade associations often will have pieces of that. There's definitely places you can go online to find some key measurements that you can compare yourself against. Budget to actual. So we budget at the beginning of the year. Here's our expectation, what's going to happen. Let's compare our financial statements to that and see, is everything going the way we planned, or are there things we need to address and adapt to? There's a lot of business health ratios you can look at. You need to find the ones that are targeted to your industry and your business, but a lot of those can be very helpful. And then key performance indicators, which we're going to have a session on in the future, but what are those key things in your business that you need to monitor and manage to make sure you get to where you want to go? So a lot of that data will come from your financial statements. So let's look at a couple examples. This is just an income statement prepared in common size. So again, the common size is just a percentage of sales. So they have some industry comparisons in here. Here's the typical industry, and then they've got 5 years of their data. And so just looking at this tells us some stuff, right? So their mix of sales between their two major departments is very different from the industry. There could be reasons behind that. There could be positives, there could be negatives, but it's information that gets you thinking about that. And then you can also see that over time, it looks like they're shifting, right? And there's some ups and downs in here between 2018, 2019. That's a significant shift. So these don't tell the whole story, but they pinpoint something that's different that helps you dig. Is this important to the organization? Is that something we need to understand? And if so, what do we do to figure out what happened and what we want to change potentially in the future? Same thing, it goes through each of these. So cost of sales as a percent of sales, very different compared to industry, especially for Department 1. So what's going on there? Why is that happening? Gross profit's another big one, right? So over time, this organization in 2016 has 42.64% gross profit in 2016, which is a lot, down to 30% in 2020. So they're making less on every sale in 2020 than they did in 2016. What's going on there? Are we pricing right? Have costs gone up and we haven't passed it along to the customer? Is our mix changing some of that? Are we not being efficient with our cost of sales or our production? It doesn't tell the whole story, but it gives you a start. So when we start seeing those trends, we should be asking questions about why this is happening and what can we do about it, if anything. So these just give a slightly different view of things that's not always obvious, especially if you have big numbers on your financial statements. Those little nuances, you know, if you have $1 million of sales and there's 2% change in gross profit, that's still a lot of money to the bottom line, but it doesn't sound so much when you're just looking at them as pure dollars. So another way to consider looking at this in a different way to just identify potential issues, problems, things to think about. This company is still more profitable than the industry. The industry's net income is 3.25, and you can see even 2020 they're 7.3. So they're doing something right, but that 7.3 is still down quite a bit from 2016. So what happened? What can we do to change that? Some business health ratios. So on the balance sheet, health ratios that are pretty common to look at, debt to equity. So how much are you owing to external parties compared to what you have invested or kept in the business? That's a big one that the banks will look at. They will also look at the current ratio. So how much are your short-term assets compared to your short-term liabilities? And that usually is some function of, can we cover short-term debt with our short-term assets? And then liquid ratio is similar to current ratio, but it takes out inventory. So it's a little more accurate in predicting short-term financial obligations because it's true liquid assets to current liabilities. So looking at these over time as part of your month-end, quarter-end review can again identify, oh, we're getting out of whack. There's things we need to be thinking about. All right, so a couple more turnovers. So all of these three, inventory, receivables, payables, look at days turnover. So how many days is your inventory sitting in your organization before it's sold, right? And so different industries will have different targets or different cycles, but knowing your own and looking at it over time can help you, again, manage. Inventories can take a lot of cash, and so you're putting money up to create or purchase inventory that might not turn very fast. So that would change your cash needs and how you operate your business versus an inventory that turns over very quickly. With receivables, that's interesting to look at. And again, you can look for trends. How fast is your customer paying their bill? How many days on average does your receivable turn, right? So I bought this from you on the 1st of the month, and are they average customers paying by the 10th of the month or 10-day turn, or are they 45? Again, very different circumstances that would change how you manage your business. And same on the payables. How fast are you paying customer bills or vendor bills? All right, and then graphical format. So some people are much more visual. So if you've got some of these things that you're like, I want to measure that, but looking at the numbers is tough, put them into a graphical format. So this organization has 15 years of data and then the industry data. So debt is green and equity is blue. So this is a very healthy organization, but there's been some fluctuations. And so does that make sense? Is that something we need to think about? Was that planned? And again, compared to industry, they're doing really well. Here's another one with 5-6 years of data that shows their sales. I'm sorry, I don't have those titles in their sales is blue, cost of sales is yellow, and then gross profit is green. And so you see sales rising typically, but you also see gross profits slowly coming down. So the year-to-year view of that probably doesn't look very big, but over time, if your gross profit is down by 5% on 40 million in sales, that's a lot of dollars. So being aware and showing these things visually sometimes will point out things easier than having just the pure numbers in front of you. All right, I think we're right at our Q&A session. I'm happy to answer questions. I know a lot of these topics are very specific to your own organization, and so it might not be as comfortable to throw them in the chat, but you're welcome to if you would like to. While we're doing that, we're going to also put a little poll up there about some future topics. Hopefully it's going. I think it is. So if you have topics you'd like to see in the future, we'd love to hear from you on that. And I'm happy to stick around for the next 15, 20 minutes or so. If you want to chat one-on-one, we can pop into a breakout room or find a time to chat along the way. So hopefully we've touched on the main areas you were hoping for. I'll give us a couple more minutes for the chat. We still have some people voting. And then we'll talk about, we do have some other sessions planned coming up that we'll share with you. Just a minute. We're about 40% voted, so we'll keep going from there. Let me see. We did have a question. So we've got someone that's in a new job that uses cash basis, but always worked in accrual. It's kind of hard to go that direction because accrual accounting definitely gives you some more detailed information on the financial statements. So a lot of businesses might use cash basis for their financial statements, but they're still tracking accounts receivable and accounts payable so that they can manage cash flow and some other portions of the business. So sometimes there's a dual basis of accounting going on, but it can be harder to get your head around if you're used to managing those accruals. So yeah, it's simpler on the financial statement presentation, but maybe a little harder to understand the health and perspective of the business. All right, I'm going to close the poll. Feel free to put in the chat if you missed the polls. This is what everybody said. So we do have some of these already on the agenda. So thank you for your thoughts on that. Coming up, we have, we're going to talk about key performance indicators. So taking a little bit more from this presentation and saying, okay, you want to create some dashboards, some key performance measures that help you manage your business. How do you go about figuring out what you're going to measure and how do you present it? So we'll have that coming up. We're going to have some our certified financial planners and tax experts come and talk about financial planning and tax planning towards the end of the year. And then we're going to have a co-host helping us with HR and employment law for small business coming up. And then we'll take your thoughts on the survey and build in there along the way. So thank you for attending. Feel free to stay on and chat if you'd like.
Great. I also wanted to just add that we will be sending out the recording and the notes, the handouts to everyone tomorrow. I know a couple people emailed just today to make sure, and so that you know, we always record these small business webinars, so you can register and know that you'll get a link to the recording in the future too. Thanks so much, Tricia.
Yeah, I do have another question in there. Someone said they're using QuickBooks to track receivables, but is the cash basis just for reporting? And QuickBooks is kind of tricky. You can actually change your basis of accounting in QuickBooks, so you should just be aware of which one you're using when. So there's the formal reporting, which are those compiled, reviewed, audited, or prepared financial statements, which need to explain the basis of accounting they're using and have a structured financial reporting mechanism. For management reporting, figure out what works for you. So if you have kind of that hybrid approach of we're going to track accounts receivable and accounts payable, but not our other accruals because it's too messy, fine. Figure out whatever works best for you that gives you the best picture of your organization and the best way to manage that. So there's a lot of ways to kind of figure out what that looks like for you. Just know if you need those more formal financial statements, they're going to be in one of those clear basis or financial reporting structures. All right. Trying to see if there's other questions.
It's not too late to submit a question. You can still type it in. And you can also send an email to us at info@jrcpa.com and we'll be able to follow up with you as well.
But thank you for attending, and hopefully you learned something and have something to take back.
Yes, thanks everyone. Have a great afternoon. See you next time.